All right. Good afternoon, everybody. Thanks for tuning in to today's webinar. And we're here with recurring guest, Charlie Bilello. So, Charlie, thanks for joining us again. I know several people have reached out to me and had extremely positive things to say about the last couple of times you've joined us. So, excited to do this on a more regular cadence with maybe some more quick hitter content here every month.
Yeah, awesome. Great to be with you. Thanks, everyone, for joining.
Yeah. So if you haven't joined us in the past and you haven't got to know Charlie, you're missing out, but definitely give Charlie a follow on Twitter and check out his blog. It's got great information all the time. Charlie does some amazing things with, the charts that you can create on YCharts and tell some really great stories with them. And, really exciting to have him join us again this month and every month going forward, just to talk about a handful of the trends and charts that he's been putting together to talk about with clients, and a lot of the people using YCharts have been hoping to do the same thing. So I guess we can jump in. We actually have a little agenda here today, Charlie. So I don't know if you want to just quickly talk through the 5 trends that we're going to spend a lot of time on, and we can then kind of jump into each one at a time.
Yeah, sure, definitely. Yeah, so it's hard to pick just 5, but we narrowed it down a little bit. Hopefully we'll get to some questions at the end this time. And so we're going to lead it off with China and what's going on there. That's the big story in markets, is the real crash, you could call it, in Chinese equities, particularly internet stocks. Then in the second part, we'll talk about how the Chinese performance compares to Taiwan and the US, and some thoughts on that. In the third part, we'll talk about valuation, and a common theme today is kind of dismissing whether valuation matters anymore, and so go through an example there, and then we'll move over to inflation, which is still very much front and center for a lot of people thinking about their portfolios. And so we have some new inflation data there, and just give updated thoughts, and obviously what the Fed is thinking with respect to inflation today. And last, we'll end with COVID and the Delta wave, and kind of what's that impact has been thus far in the economy, and the potential into the fall and the winter.
We've got a lot to cover, so we'll jump in. You did bring up a very important point, Charlie. If you have any questions as a listener today, feel free to enter those into the Q&A kind of in the Zoom, right? So we'll keep an eye on those. We'll do our best to answer them either as we go or at the end. And then some questions you might get a response offline from someone on our team that's keeping an eye on those too. But, no shortage of content to get through in a year, and, I guess, a couple of years now that seem to have no shortage of market events. But let's start with this phenomena, the China crash. And we've got a couple charts to jump into here, but this is the first of 3, Charlie. So can you tell us what's on this chart, and then we can dig into kind of the story behind it?
So we have here a long-term ratio looking at the MSCI China index versus the MSCI United States index. So just looking at a broad basket of Chinese equities relative to US equities over time, going back to 2000. And I think the recent experience in China would have a lot of recent market participants believe that this has always been the case in terms of China underperforming. But if you go back to the early 2000s, China was very much where the attention was focused from investors. There was this big growth story coming out of China. The growth rates there were incredible. If you high single digits in 2001, 2002, and all the way up to 2007. I think the stated reported GDP, whether you believe it or not, was I think around 14% when it peaked in 2007. And since then, you've seen just this dramatic turnaround where U.S. stocks have outperformed Chinese equities. Growth has certainly slowed there, but it's still, if you believe the numbers, still pretty high, at around 6% GDP the last few years, and just Chinese stocks are moving in the other direction. So it's just a backdrop giving you, an idea that there's cycles to everything, and we've seen these long periods of cycles. If we go back to 2007 and you look at Chinese equities and their valuations, I think it would surprise a lot of people that they were trading at multiples of almost double the U.S. market. So it wasn't always the case that Chinese equities were trading at a discount like they are today, they were actually trading at double U.S. equity valuations. And, over the last 14 years, that multiple has kind of come down to the point where if we look at CAPE ratios today in the US is more than double China. So obviously the big question is, what's going to happen going forward? And this is just giving you the perspective that there are these cycles that investors should be aware of.
It's always the big question, right, Charlie? What's going to happen going forward? But I think one of the things that jumped out to me when I saw this chart for the first time was a little bit surprised to look at this period of time between 2000 and now and actually see, based on this ratio chart, had you invested 100% of your assets in China or the US, you'd actually kind of end up at about the same point right now, right?
That's right. Yeah. So assuming, right, you started in 2000 and, back then it was a little bit more difficult to get broad exposure to Chinese equities. We have now a myriad of ETFs that you could pick from, but let's say hypothetically you were able to do that back in 2000. Yeah, you've been pretty much flat with just huge swings in both directions. So you'd be feeling, if you had a position in or an overweight in China, you'd be feeling great from 2000 to 2007, and then obviously the last 14 years opposite, where any exposure, and not just China, but if we look at a chart of emerging markets, it's going to look very similar to this because of China's weight there, and just US has been outperforming everything. So really any exposure outside the US over the last decade plus has been exposure that you wouldn't want to have. So diversification would say you want to have everything, but that's going to lead to pain sometimes, and other times going to lead to you feeling good about it. And so obviously the last 10, 15 years feeling not so good about having exposure outside the US.
Yeah, and I think next couple of charts here are going to highlight that even more. But this one's showing a very specific type of chart on a specific ETF, right?
Yeah. So when you think about China is obviously huge, and they have various markets and sectors just like the US. But what's been most captivating for US investors, global investors, is getting exposure to Chinese internet companies, particularly because a lot of the US internet companies are not allowed in China. So you have these natural monopolies and companies like Alibaba and Tencent that investors really have loved for years and years and years. And since February of this year, we've just seen this absolute crash in pretty much all of these names. So this is the KWEB ETF, which is a basket of Chinese internet stocks, and it's down over 50% since February. The amazing thing, of course, is if we showed a chart of US stocks, which we can show in the next chart, they've been doing quite well over the same period of time. So US internet stocks are hitting new highs, while Chinese stocks are hitting 52-week lows and down 50%. So this chart here shows that divergence. And really, you can see in February, it wasn't that long ago, where actually Chinese internet companies were outperforming, right? So following the pandemic last year, same trends you had in China as you had in the US, with internet, anything related to the at-home economy doing well. And, in February of this year, that flip for China, where fears of government intervention, increased regulation, just worries about shareholders actually having control of the company versus the government having control of the company, really have led to this collapse. And the fascinating thing is that US stocks just keep on trucking. So if we looked at NASDAQ 100, it's hitting new highs today, while you have China in this very deep drawdown. So that's kind of an unusual thing to see this, because typically these internet names trade very correlated to each other. So seeing this divergence here is something we haven't seen in quite some time, perhaps ever.
Yeah, Charlie, and you alluded to this divergence not being due to reduced demand for internet in China or any fundamentals for the companies in the underlying index or the underlying ETF. Our next section kind of jumps into that in a lot more detail, where you've outlined this freedom premium, right? So talk us through this table and kind of how investors are looking at different countries and how that's affecting the returns in the long run.
Yeah, so this is a table I pulled together in Excel using the great YCharts Excel add-in, so you could pull in various data, year-to-date returns, a lot of different good data there. So recommend anyone who's using that or isn't using it to get on that. So this is a table showing every year since 2011 the performance of various country ETFs around the world. These are the biggest equity markets. So this is from a U.S. equity investor perspective, all ETFs in the U.S. And how those various countries have done since 2011. So on the right side of the chart, you'll see U.S. at the top of the list, almost 15% a year annualized, which is well above long-term average in the U.S., which is around 10%. But you just see this interesting dichotomy here with Taiwan actually up 9% a year over that time period, while China, the FXI ETF, up around 1%. So this is just a concept that I think investors are, whether they know it or not, they're placing a premium on freedom. Taiwan's obviously very different than China in that it's had a freely elected democracy since the early 1990s. You have freedoms there that just simply don't exist in China. Shareholder rights are obviously front and center here. So I think it's an interesting dichotomy that right now, here today, investors, at least if you look at valuation multiples, you look at the returns, they're placing a premium on countries that have more economic freedom.
So for those of us that tuned into the Olympics, earlier this month, at the end of last month, and saw, Taiwan competing as Chinese Taipei, I guess when you think about it from an investment perspective, those two countries or those two regions are very different, though, correct?
Yeah, I mean, we don't have to get into the complicated political debate. If you ask the Taiwanese people, and I think they would point to, they would obviously want to remain separated from China, and they would point to the success that they've had. They're, if you look at per capita GDP, Taiwan's, in the top 20 globally. They're doing very well. The standard of living is very well, and they have these freedoms. So, I think that there is an argument to be made that having freedom in the long term will lead to better outcomes, not only for economically, but for individuals in terms of their satisfaction, everything else. So I think that innovation, if you don't have freedom at a certain level, it's going to stifle innovation. And I think that's the big question for China going forward. Can they maintain the growth rate of the past and limit freedoms and really get involved more in companies? And they'll have to make that decision, right? They have a different objective, obviously, than the U.S. And every country has to do what's best for them. But I think they may want to think twice about how much they want to intervene in terms of markets, because much of the success, obviously, they've had since they started reforming and becoming more economically free is due to that. So do they want to reverse course on that? I think that would be a difficult thing for the Chinese people, and it could put their own power in jeopardy. So that's a bigger picture question. But for now, I think the takeaway from this is that investors, for sure, are discounting that lack of freedom, and it remains to be seen whether in the future that was correct or not. But that's the bet that they're making, that future profits and future cash flows are going to be impacted by this intervention.
Yeah, certainly compelling data. Another question we get a lot when we see these tables or charts with a lot of different ETFs, representing investments in different countries, is how the currency exposure might affect these returns. Now, I see this table is all in US dollars. So can you just briefly touch on what that means as far as how an investor would be impacted by any currency fluctuations?
Yeah, sure, absolutely. So for U.S. investor, if you're investing in these ETFs, they're not currency hedged. So you're going to receive either the appreciation or the depreciation. So if we pick Japan, if we look at if the Japanese yen appreciates over this period, versus the dollar, you're going to benefit. If it depreciates, you're going to be hurt by that currency fluctuation. So that's built into there as well. If we look at something like China, it's not as big of an issue. If the Chinese yuan, it's been pretty stable the last 10 years versus US dollars. But certainly for many of these countries on this list, the US dollar has outperformed over the last 10 plus years. So, that's been an additional factor weighing on international exposure if you don't have that currency hedged, for sure.
Got it. And jumping into the second chart here, where we can actually see that performance you talked about of the US versus a couple of these other ETFs or indices here.
Yeah. So, first part that jumps out is the US is in really a league of its own. If we put any number of countries in there, they're all going to be below the US. So this has been a period most similar to the 1990s, where you had just US tech domination, and that leading to multiple expansion in US equities, which is now at its highest level since 2000, and just other countries have not kept up with that. So while US companies have done better than other countries' companies over the last 10 years, it's been the valuation expansion that's been the more important factor. And so if we looked at a chart here of US versus emerging markets, it's going to be somewhere in between Taiwan and China, and you just have this interesting situation where there's long periods of outperformance from the US here. Will you have a similar period like we saw from 2000 to 2010, where US equities underperformed and emerging markets had a comeback and they did particularly well? So I think for US investors, and we talked about it a little bit on the last webinar, but if you're not diversified internationally, if you don't have any emerging markets exposure, now would be the time to consider that, because you're getting a valuation discount like you haven't before. So there's certainly a lot of bad news going on in emerging markets. And if we look at growth rates, we look at many different factors, political instability, it's certainly not as easy to invest there as the US. But that might be a reason by itself to invest in it, because you're getting this discount going forward.
Yeah, before my time at YCharts, I was actually a bond trader, traded spreads. So whenever I see spreads opening, I get excited about those widening spreads and finding investment opportunities on buying what's discounted there. So
there isn't much. Yeah, there isn't much today in the world when you look around the world that's trading at a discount to its historical levels. So emerging markets is one area, but there isn't much if you're looking globally, from bonds and stocks and real estate. This would be the one area where sentiment is really bad. Right? The question is whether it's justified. So even in China, if you're a bull, you would say, well, China, the government could come out with a statement any day and really alleviate these concerns, right? And at a certain point, they'll likely do that. If they view the calculation as hurting them or jeopardizing their power in some way, then they're going to come out and do that. So, I don't think that this is just going to be a collapse and it's going to be the end of these companies, right? So the question is sentiment at a breaking point where it's so bad now that it just has to snap back? And if we look at companies like Alibaba, which we'll talk about in the next chart, the expectations have come way down, right? So your margin of safety is a little bit better right now than in the past, where it's trading at these huge premiums.
Yeah. Before we jump into that next section, the last thing I'm reminded of here, right? The last webinar we did together, Charlie, you highlighted a trend that you actually identified at the beginning of 2020, which was just the reversal in sectors and different investment areas, right? Where we've been seeing this phenomena a lot over the last couple of years, where any asset class that does seem devalued or beaten down, when we take a look at it a few months later, it seems to have snapped back. So that trend's certainly been prevalent and something that you've noticed in a lot of areas, this aside, over the last year or so.
Yeah, well, we saw it right with COVID, where whether it's value stocks or certain sectors like energy and financials, There was just, they were at they were at really crisis level, multiples, crisis level sentiment, and we just saw a huge snapback. When the vaccines came out, when we had the stimulus. So, beaten down. Contrarian investing isn't dead. It's hard to do. It's hard to go against the tide. But certainly, there's the hardest thing to invest in today, I think, is emerging markets, or in general, or China, or Chinese internet in particular. And if history is any guide, now would be an interesting time to at least start looking at it. If you don't believe that the whole sector is going to just stay down, or you don't think that the government's going to nationalize these companies, if you don't have that extreme bearish view, there might be some pockets of opportunity there.
All right, we'll jump into the next trend, right? So you've been thinking about the holdings and individual companies kind of within these ETFs, right? Really interesting valuation study that you did on your blog recently, and this highlights that.
Yeah, I think the most common refrain, I think, in the past year we've had this extreme run up in markets, is valuation doesn't matter anymore. And you could use that in any number of examples. They used it in talking about IPOs coming out at 100, 200 times sales. They used it in the SPAC market, which was before they even bought these companies, just running up 50% or more. And just this notion that, well, we're in the new world where valuation doesn't matter. And, if you go back in history, during any mania, that's a refrain that's used to justify it. Well, you can't look at valuation anymore. They said the same thing in the dot-com bubble. These companies are different, right? And so I think the story of Alibaba and Amazon is kind of playing out, or will play out in the years to come. So this first chart here is a chart of revenue growth so Alibaba goes public September 2014, and if you remember Jack Ma ringing the bell in the New York Stock Exchange, it was just a lot of euphoria. This was like a tremendous moment for China and the internet, and coming to the US and going public. It was the biggest IPO of all time, and the expectations were incredibly high. And if we fast forward to today, you would say, wow, those expectations were justified, right? You have 1,000% revenue growth for Alibaba since it went public in 2014. That's so far ahead of the average stock, or the S&P 500, or even Amazon at 420%, far below, right? And Amazon is ahead of 99% of companies when it comes to revenue growth over that time period. So if you looked at this chart, Caleb, what would be your guess in terms of how the stocks have performed, since Alibaba, went public? If you knew nothing else and you just knew, okay, the expectations were high, but gosh, they grew 1,000%. What would you believe in terms of future returns? If we go to the next chart.
Yeah, I mean, looking
you
at
already know the answer, but
well, I know the answer, but just looking at the revenue chart and having looked at a lot of fundamental charts and knowing how that stock price usually tracks, you'd expect Alibaba to be up multiples of the return that we've seen in Amazon.
Yeah, absolutely. And so kind of shocking to see the opposite here. So Amazon up over 900%, and Alibaba up 65%. And you say, how in the world did that happen? How did we get to that point, given that revenue disparity? So if we go to the third chart here, well, this is how we got there. So you go back to the Alibaba IPO in 2014, and it's trading at 20 times sales. And so expectations were extremely high. And you contrast that with Amazon, whose sales were less than 2 times sales back then in 2014. So just a huge gap in terms of expectations. And while Alibaba did incredibly well executing, since 2014, what investors likely didn't anticipate was this multiple contraction. So their expectation of future growth obviously is coming down, 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 down to the point where today the two are at parity in terms of their price to sales ratio. So Amazon has, as its price to sales ratio has almost doubled over that time period from less than 2 to 3.7, but Alibaba has come down from 20 to 3.7, and that contraction in multiple outweighed almost all of the fundamental growth in the company. So the lesson here is that when expectations are just exceedingly high, very few companies can grow into that. And that's always the saying, well, they're going to grow into it. And that might be the case. And there's a few companies that can actually, say that in history. But more often than not, valuation does matter. And you just don't know when it's going to matter. And so for Alibaba shareholders, it's really mattered in the last 6 months, right? Investors questioning whether that future revenue stream is in jeopardy, whether the future earning stream is in jeopardy. Well, all of a sudden they're not paying 9 times sales like they were earlier this year. They're paying 3 times sales, and that changes everything, right?
Yeah.
So
what a powerful picture too, just to see that exuberance right at the time of IPO, and just over time that slow kind of grind back to I guess more of a median, right? So.
Yeah, and how many companies in the last year, great companies, right? Cloud companies, Snowflake is something that I've written about, right? It comes public, it goes up to a multiple of over 250 times sales. So 250 times sales. Just think about that. Alibaba's at 20 times sales, and it couldn't grow into that. And maybe Snowflake will be the exception. It's just its growth its growth rate is incredible today, right? But will investors 10 years from that Snowflake IPO, will they be telling a similar story? We just haven't seen companies come public at these types of valuations since 99, 2000. So the expectations are exceedingly high. And even if these companies execute, the stock is different than the company, right? So what you're owning as a shareholder, is that future stream of earnings. But at the end of the day, you're paying a price on that future stream of earnings. So if you pay too high of a price for that, and that converges, that's going to factor into your end return. So I think this is an important thing for investors to think about the next time you hear that phrase. Well, valuation doesn't matter anymore.
Yeah, indeed. And as much as I'd like to keep talking about fundamentals, we've actually already had a couple questions kind of get chatted in around this next topic, which is just so top of mind for advisors and investors everywhere. But think about inflation and how transitory is the movement we're seeing right now.
Yeah. So since last month, we've had another CPI print, and it was definitely above expectations. Overall CPI at 5.4%, still the highest since 2008. Core CPI came in a little bit, but above 4%, much higher than expectations. And I think even the Fed, if you look at the minutes of their last meeting, they're starting to acknowledge slowly that maybe this is persisting a little bit longer than they expected. So the notion that inflation is simply higher because of this concept of base rate, so it's just higher because it's comparing to low figures from last year, that's kind of being discredited here with it staying at elevated levels here. So if we were, and it's likely to come down from these levels in the months to come because of those base rates, but if it stays above 3%, stays above 4%, that's a change, and there's a reason to believe that it could stay elevated for some time. We have supply shortages just persisting. We still have high demand. If we look at things like semiconductors and its impact on autos, that's just one great example where it's hard to see the price pressure not remaining high for some period of time, given the shortage there. We've seen Ford, GM, Toyota all saying that their production numbers are way down, and not due to a lack of demand. There's record demand, but due to just they need these chips for everything in a car today, and they can't make the automobiles without them. And so you have the situation with the Delta variant. It's putting pressure on the supply chain again. We'll get into that in the last segment, but I think the notion that transitory meant one month or 2 months of higher inflation, I think that's going to be a story here for at least the rest of the year. And there'll be pockets of things, and the Fed has talked about things like lumber, which has come all the way back down and down over 70% from its peak early this year. But what they don't tell you is that housing prices have not come down with that. So, we got data on new home prices yesterday, hit another record high. And what home builders have said is they can pass that. They jacked up prices due to the lumber costs. I think they said earlier this year they jacked up new home prices by 30,000 on average due to the higher lumber costs. Now lumber's come crashing down, and and what they're saying is there's still so much demand and so little supply of new homes that they can keep prices elevated and just keep. I think the CEO of one of the companies said, we're just going to keep that as in our margin. So we're just going to add to our margin. So that's inflationary, right, for the time being. But,
Yeah.
For sure, the things like wages are going to be stickier. It's hard to cut people's wages after raising them, and we've seen just a shortage of supply in the labor market, and that alone is going to keep things elevated.
And I know another chart that we looked at last time to kind of keep this number, I guess, in perspective, or how people are actually feeling about it, right? These polls always have a little bit of flaw as far as how that data is collected, but this is an alarming pattern on this chart.
The New York Fed puts out this survey every month, and what are you expecting over the next year in terms of inflation? And this is the highest we've seen. They only started the survey in 2013, but consumers are expecting close to 5% inflation going forward, right, the year ahead. And so while that might not end up being correct, it tells you that it tells me anyway that they'll be tolerant of higher prices, and we've seen that in terms of their consumer behavior, where spending is still well above pre-COVID levels despite these price increases. So there's a number of factors driving that, from stimulus. So there's still, consumers are in a great position, having saved a decent portion of the stimulus. Remember, their wages are going up. They're in a position to buy, and they're getting used to these higher prices, which is an interesting phenomenon. So I think that tells you also that if companies are able to push through these higher prices to the consumer's willing for now to keep spending, then above average rates of inflation could persist for at least another year, right? So I'd be surprised, I think, if we saw inflation come right back down to 2% where it had been the prior 20 years, just given these dynamics. It's just, next month, the month after, it's just not likely.
And our next chart is going to look a little bit about how that's affecting bond investors in that environment. But a couple of questions that we've had come through that I think we could talk about right now.
Yeah.
Thinking about the investment environment and how inflation's affecting it. I think there seems to be some attention specifically looking at metals like gold and especially silver. Where do you see, those things fitting into this investment environment?
Yeah, gold and silver. Yeah. So I've written a lot about gold and the notion that it's this perfect inflation hedge, or the best inflation hedge. If we look at history, it doesn't bear out. If you go, gold futures started trading in the mid 1970s, and if we look at the various cycles of inflation since then, it's had a return above inflation, but not very much. Stocks have returned about 6-7% above inflation. Bonds have returned a few percent above inflation. Gold is maybe 1% above inflation. So as a long-term hedge, since gold futures started trading, it's at the lower end of the spectrum. And then we've had these 20-year periods where, if you look at gold from 1980 to 2000, gold was down 50%. And obviously you're averaging over 3% inflation during that entire period. So again, the notion that gold has to go up with the rate of inflation, it's not. The data doesn't back that up. I think the most surprising thing for people, it certainly surprised me as well, right? You have just huge amounts of government debt. You have money supply increasing, and you have gold down over the last year, right? And maybe next month we'll get into some charts there with gold and crypto. But obviously, digital gold has kind of replaced gold in the mind of investors as this defense against easy money, defense against higher, currency debasement. So I think that that is a factor there, but I think it's certainly surprised me, and I'm not surprised that other people on this call are surprised by it. Maybe gold doesn't do as well as crypto, but the fact that it's down over the last year is surprising. But maybe sentiment has soured in on it enough where it's going to go on another run.
Maybe another play there for a kind of beaten down asset.
Yeah, gold is very much an enigma. If you try to analyze it compared to anything, and you look for drivers of gold, what you'll find is it's very uncorrelated to everything, which makes it attractive as a part of a portfolio, but it can be extremely frustrating because the economy can be doing very well and gold is doing nothing. And then the opposite could also be true. I mean, gold had a great run in the early 2000s to 2007 during that bull market, but during the current bull market, not so much, right? So you could point to 20 different cycles where gold has behaved differently with the same underlying fundamentals. So sentiment is the important driver. Real interest rates are a factor, and I've looked at that. If you're looking at one factor, so higher real interest rates tend to be bad for gold. But look at this chart here. I mean, in terms of real interest rates, it should tell you that.
Yeah, it was a nice transition.
The gold, it should tell you that gold should be doing extremely well, and it's not. So that even the best indicator of gold is not doing so well here and now. So this is a chart showing the 10-year Treasury yield is around 1.2% now versus the inflation rate, CPI is 5.4%. And the spread that we're seeing now is your real interest rate. So the rate minus the inflation rate is below 4% for the first time since the early 1980s. And so just remarkable that we have this spike in inflation, 6+% GDP expected this year. We have all of these factors that should be leading investors to sell their treasuries and have the yield rise, right? We have all this new supply of government debt. Why is the 10-year still at 1.2%? And so this is a fascinating thing. Bond investors, after inflation, haven't been compensated less since 1980. And in 1980, you're looking at above mid-teens on the 10-year Treasury. Today, you're looking at 1.2%. So this is not likely to stay negative 4% because the CPI will go down, but it might be some time before investors receive a positive real yield on their money unless interest rates start moving higher.
So what are you looking for out of the Fed for the next foreseeable few months? What kind of messaging? I know you'd mentioned the fact that they're thinking about tapering their purchase program, but what are some of the key tidbits that you'll be looking to hear that would change your outlook?
Yeah, I think the Fed is very comfortable staying where they are, certainly in terms of keeping 0% policy. They have new ammunition now. Powell's talked about the virus a number of times as a driver of things, and now we have the Delta wave, and that's going to certainly impact certain sectors. And there's concerns that it might lead to a dip in terms of growth. And so he has the justification, and they talked about 2023 for some time in terms of raising interest rates. So I think that's safe for at least another 6 to 9 months before they start talking about that. But the balance sheet, the change in the last meeting, if you look at some of the language there, they may start to taper, right? They're doing 120 billion of purchases between treasuries and mortgage bonds a month, which is incredible. They may start to taper that at the end of this year. I say may because if there's any downturn in the economy, if there's any hint of trouble in markets, they'll probably push that back. So it's very much dependent on what goes on between now and then. The Fed, as we talked about in the last discussion, the Fed is more than ever before not afraid of inflation one bit. They're going to keep their foot on the gas pedal. They seem to have the belief that there's no downside to having easy money, and if that's the belief, then you do it until you see that actual downside. So the next meeting we'll have in September, you're going to hear very much the same language, keeping rates the same, not touching the balance sheet, and then we'll see from there if they start to taper. But remember, tapering just means slowing down that 120 billion. It doesn't mean stopping it. Certainly doesn't mean unwinding it, right? So it's still going to increase just at a slower rate. And will that be the point when bonds start to push back up? It's certainly possible. At any hint of it will cause pressure on it. But I think you have these other dynamics that must be driving treasury yields lower. Just the fact that Europe and Japan are still at negative interest rates. There's still demand for these securities. It seems crazy. It's crazy to me that there's demand for a 10-year treasury bond at 1.2% when inflation could be averaging 3%, for the foreseeable future. But it doesn't matter. The Fed is buying it, and there's certainly other investors buying it as well. So somebody thinks it's good value there, even though it's negative after the inflation rate.
Sure, and one of the the factors you mentioned, the Fed's for sure going to be looking at, and one of the things that could most likely spur another stimulus or more purchased by the Fed, or them being committed to keep money cheap, is this new wave of infections, right? The Delta wave.
Yeah. So I was hoping to be done with talking about COVID, but COVID is not done with us just yet. I suppose here, this is a chart of hospitalizations in the U.S., and you can see it's pretty dramatic rise since early July. So, just before that, hospitalizations had hit pandemic lows. Cases that hit pandemic lows, deaths had hit pandemic lows. We seem to be in a pretty good place, right? We had pretty high vaccine efficacy, looking at the data in the US and Israel and the UK and elsewhere. And then all of a sudden we saw what happened in the UK with their wave, and in Israel with their wave, and then the US with a lag is showing something similar. So where we are today with the Delta, the good news is that the severity of cases, if you're fully vaccinated, the hospitalizations and deaths, it still decreases the likelihood of that. If you're looking at different studies, it could be anywhere from 80s to 90% still effective against severe illness. But the difficulty is that there's still a good number of people in the US that are not vaccinated. And at the infection level, what we're seeing from the data is that this Delta variant is, breaking through fully vaccinated. So there's been a number of studies, but I guess the Israel study is the most concerning, showing it perhaps is only 40% effective against the Delta variant if you're fully vaccinated. So if that is indeed the case, then you're going to see what we're seeing here, which is in spite of having now the U.S. has passed 50% in terms of full vaccination rates. In spite of that, you're going to see an increase in cases. And just hopefully the severity of those cases is not going to be as much. But as we talked about, there's still a lot of areas of the country where vaccination rates are lower, and there's enough people that haven't been infected yet in those areas to lead to this Delta wave. So hopefully what we're going to see with the boosters coming soon, that will alleviate things. So Israel's given a million booster shots, a third shot of the Pfizer vaccine in the past few weeks, and thus far they've seen very good outcomes with that. So the U.S. is paving the way for older people and more vulnerable people to get that booster after 8 months, and if we can roll that out and get that going, I think that should help a lot. But in terms of what the wave has meant so far, it's really just in the past few weeks, right, that we're seeing this. But this is a chart of the airlines ETF, jets, huge run up coming out of the gate as the virus peaked in January in terms of hospitalizations and deaths, and people started traveling again. We got up to I think just 15% below pre-COVID levels there in July, right before the Delta wave. And what we're seeing here is the Jets ETF give back all those gains, and perhaps investors are being too pessimistic, but we are starting to see a little bit of a slowdown in travel. We're seeing a slowdown in restaurant visits, grocery store visits. So we're starting to hear talk of companies as well pushing back their schedule to go back to the office. So things like that, could certainly, as we head into the fall and colder weather, winter months, the concern is that people will start pulling back and reverting to those earlier COVID habits.
Yeah. So, this chart shows, that dramatic decline as things have gotten worse. Is there anything else at play here, though, that you're thinking of? I mean, we've talked about valuations, we've talked about investor exuberance, and kind of these movements in the markets that snap back and forth. I mean, are you looking at some of the recovery stocks and seeing them trend most closely with the resurgence in infections, or is this just cycles in play?
Yeah, you're seeing this is just airlines, but if we showed cruise lines, they're showing something similar. If we look at energy, right? So if you think demand's going to go down, we saw crude oil sell off 20% and energy stocks sell off. So this very much is going to be virus dependent, but the market will move very quickly once we hit a peak in the Delta wave. So the Delta wave is not going to last forever. If we look at other countries that have had their wave before us, like the UK, there will be a peak at some point. The question is, how quickly will it then fall from there? And as we get, to other regions in the US that haven't been hit so hard with the Delta so far, like the Northeast and the Midwest, when we get into the fall and winter months there, and people are spending more months indoors, is that going to have an impact? So I think for the time being, you're going to see back and forth with these sectors. But I think the more interesting thing is the market is hitting new highs overall despite that. So it's nothing like March 2020, because I think people have kind of realized that we'll get through it, and if it gets bad enough, there likely will be more stimulus. We have, certainly the infrastructure in some form or fashion will likely be passed this year. And there's a talk of much bigger multi-trillion-dollar, stimulative efforts coming as well. Whether that gets passed, I think it'll be a bigger fight. But I think investors, for now are not concerned with the Delta wave. They're looking ahead to the future when this COVID-19 becomes just another coronavirus, and that hopefully that's what it will become. It'll keep spreading until it's just about everyone, but it'll become less and less severe over time. And if there is an economic impact, the government has shown every willingness to borrow more money and send it out to people. So that's the expectation right now. It could be wrong, but it is incredible to see a market hitting new highs, despite some of the factors that caused that crash and initially in March 2020, despite some of the same factors going on.
Yeah, well, I certainly think we're, everybody's aligned on hoping this is maybe the last time we talk about some of these charts on the
absolutely
the virus infections and hospitalizations. We did get a handful of questions, Charlie. Do you have time to stick around and answer a few?
Yeah, let's do it.
All right, sure. Perfect. So one of the first questions that came when we were talking about China and Taiwan and emerging markets, thinking about those two countries in particular, but then when you think about emerging markets exposure in general, what do you look for in an ETF to get that emerging markets exposure? Yeah,
there's a million ways you could slice it. You you starting point that I always think about is start out with the most broad and then think about how you want to perhaps deviate from that. Right. So I guess the most broad would be either the MSCI ETFs like IEMG or EEM was the old version with a higher expense ratio, but or the FTSE like the VWO from Vanguard. Those would be the two biggest right now, are VWO and IEMG, and you start with that and you say, well, what am I owning in that, right? And if you look at the China weights there, the 33% in one, 37% in other. So China is obviously a big factor. But if you just want pure exposure, broad exposure to market cap, low fee to emerging markets, you'd probably go there. If you want to go one step further, you could tilt towards lower volatility. They have low vol ETFs. So if emerging markets are much more volatile than U.S. equities, and if you think your clients can't stomach that or you can't stomach that, you could look at the lower volatility, similar to the U.S. lower volatility emerging market equities, and then from there, you could. We talked about China and the question with that, and I don't. There's no way to analyze what's going on in terms of whether it will continue or not, right? I don't think anybody, if they're being honest, will tell you they have a good handle on whether China's going to keep going in the direction of the past few months or go back, to more market friendly, type of attitude. But there are certainly options if you don't believe China. If you think it's too risky, there's certainly options to buy ETFs without China exposure, as well within emerging markets. And there's, just like U.S. equities, there's emerging market value ETFs you can buy. So if you want to tilt towards that, as well. So you can kind of pick. I think for most people, having a broad emerging market exposure at the very least makes some sense because of the different fundamental drivers, and you can have that could be very frustrating at times, but that's part of a diversified portfolios to not have everything working at the same time. So I think there is a case to be made, despite and perhaps even because of this long period of underperformance, that you actually perhaps today want to have that exposure in your portfolio. So as much as in 2007, investors loved emerging markets, they had a great run. You would be happy to have that in your portfolio. Today, it's the opposite. So that alone makes me interested in that as an asset class, right? And then from there, it just depends on your factor view. Do you want a factor tilt? Do you want to take a view on a country and saying one versus another? But that's a next level analysis.
Got it. Another question, and I guess a couple of questions have kind of focused on, and you've talked about valuation, had a few questions focused on just the overvalued nature of the market in general. How are you talking about that with your clients as far as just investing in equities in a point when everything does look so overvalued? Is that a danger that you're bringing up in conversations, or something that you're concerned about?
Yeah, sure. Yeah, you have to. I think you have to lay it out there that we don't have many historical precedents, first of all, for this type of valuation. So again, if we're talking about the CAPE ratio or the Shiller P, it's only really the period of 98, 99, 2000 that had higher multiples. So we're almost there. Another 20, 30% run up in the S&P, and we'd be right there with peak 2000, CAPE ratio multiples. If we're looking at something like price to sales, we're already above those peak levels. So without question, when valuation goes up, risk goes up as well. So your risk tolerance, your tolerance for drawdown, you have to be mindful of that. And you should be telling investors that risk is elevated. You have to be willing to withstand higher volatility and higher drawdowns because of these higher multiples. And then from just an investing perspective, you should be expecting lower returns, right? So we showed that chart of U.S. equity returns, 15% a year over the last 10 plus years. If the next 10 years did that same level, we'd be talking about Japan, 1980s, late 1980s Japan in terms of a bubble mania valuation level. So nothing's impossible that could happen, but I think just starting out and telling people that, look, expect if you're starting investing today, expect there to be a huge decline in the future. You should always have that, but perhaps now more than ever, right? And so have a balanced portfolio so that you could take advantage of that if and when that comes, right? We know that the risk reward is not great today, but it won't always be that way. There will be better risk reward in the future. We just don't know when. It could get worse. The risk reward could just keep getting worse and worse and worse, as it did leading up to March 2000. But then, at any point in time, you can have a March 2020 where the risk reward improves very quickly, right? Nobody knows when. So keep optionality in your portfolio. That's why having cash and other things that to take advantage of those moments, I think, is important. But there's no easy answer, right? You can U.S. equities are overvalued. Well, go to emerging markets. Well, who wants to invest in emerging markets after everything we just talked about, right? And if U.S. equities are going down, emerging markets are going to go down as well. So it's not as if they won't go down. It's just looking out longer term. There perhaps could be a better risk reward there. So it's a tough question. And definitely next month I'll put together some charts showing where we are with that and potentially how to think about that. What can you do about it, right? And really, what you can do about it is just diversify, right? Out of large cap U.S. tech centric equities, right? That's really the biggest driver of that valuation premium, right? But that means selling Amazon, Apple, Facebook, and Microsoft on the belief, and Google on the belief that the next 10 years won't be as good for those companies. And it's so hard for investors to envision that, just given how well they've done.
Yeah. Hard decisions to justify too down the road if it doesn't work out, right?
Yeah, absolutely. That's why diversification first and foremost, right? Because that's just hedging your bet. It's hedging against your inability to predict the future. So if you could predict the future, you would invest everything in the best performing asset class, right? Why wouldn't you? You'd be super concentrated. But since you can't, the only protection against that is diversifying. And the downside of that is there's going to be things in there that underperform that best asset class naturally, right?
Yep.
Yeah.
All right. Well, Charlie, thanks. I'm gonna wrap things up here just because we're hitting the top of the hour. There were a few questions also about the charts themselves. Those are they will be available within YCharts, right? So if you go into the fundamental charts and go to start from template, we'll have Charlie's charts loaded up there for YCharts users to get to. But also, Charlie, if you've mentioned in the past, if you want to grab those from your blog, you're okay with that as well, right?
Yeah. Yep. Absolutely. Please do so. And thanks everyone for joining us today. It was great discussion, Caleb, as always, and look forward to next month.
Yeah, can't wait. Until then, take care, Charlie.
Take care, guys.
All right, thanks everybody.